Hey, Rick and Mike, and right now we're talking bonds. Bonds are actually having a little bit of a comeback here. Been a dirty word for a while, but we are on the hopefully the precipice of a couple rate cuts. Fed still is doing their favorite wait and see, but we hopefully we'll see fairly soon. Mike, we are seeing a reemergence of bonds because why?
Well, I think the thing to understand about bonds that's important is that these are loaning investments, meaning we're going to make a loan to either the U.S. government in the form of a treasury bond or a corporation as corporate bond, and there's many different types of bonds. When we make that loan, there's a couple things that we know, barring default, meaning they are unable to pay it back. We're going to say make a loan for $1,000. This loan is going to be for 5 years, and we're going to get 5% interest, say, per year over that time period. There's a high degree of certainty around that, assuming creditworthiness is good. But today, for investment grade, high quality, relatively high quality bonds, you can get a starting yield of north of 6%, which is it's almost threefold higher than what it would have been 3 years ago. And when you look at the starting yield for a portfolio, PIMCO has done some research on this. There's a 93% correlation to your starting yield and what your total return is, meaning the price appreciation of the bond or depreciation and the income combined over the time horizon or the duration, not to get overly technical for your bond portfolio. So, if you can get 6% today from high quality bonds, and I think inflation is projected 2 to 3%. That's a positive real return.
Yeah, you guys are sitting on cash. Like, we get this question a lot, like money markets or even CDs or bonds. What should I do with my cash? Bonds are going to be very different. Unlike a money market, or they're going to reset every 7 days. So if the Fed does lower rates, you're going to get that rate for another 5, 6, 7 days, and then you're done. Investing in a bond at 6%. I mean, when rates go down, current bond prices go up, which is what Mike was just kind of talking about. So the long-term expectations there for bonds. So if you're sitting on cash, I mean, I'm putting my cash personally in some sort of investment grade bonds that I'm getting some sort of price appreciation plus 6%. I mean,
yeah, the starting yield is higher, provides some cushion against potential interest rate increases. Certainly cash has its role. We're not downplaying that. We hold cash. We recommend everyone have 3 to 6 months worth of living expenses in cash. But beyond that, it's important to start considering bonds as a good source of income stability. In particular, in a diversified portfolio, they can really add ballast in the event of, say, a recession or something like that.
Bonds coming back into the limelight can actually be a portfolio accelerator going forward. We shall see. We shall wait and see, as the Fed says. Hopefully we stop waiting. Thanks a lot. We'll see you soon.